Hey guys, it's Kyan again. Now, if you have money to invest right now, but one question just literally keeps stopping you, and that question is now actually the right time to invest my money in the financial markets? Because you may have watched the news today. You may have read many different articles sending you conflicting signals, such as the S&P is wobbling because of AI, but then JP Morgan may be telling you that the S&P is now forecast to rally because buy signals are flashing, for an example. You may have then gone and checked the charts and seen that some of the major sectors in the stock markets are down 20%. The stock market's not moving higher. And now you start to feel like you don't have a clear answer. So if that sounds familiar, that's not a you problem. That's a common problem facing millions of people just like you. And that is because most investors, including yourself at this current stage, are trying to answer forward-looking questions without a macro mechanic framework that's used by macro investors to predict where the markets are going. Okay, so while 95% of retail investors are watching the news reports, and remember, the news is reporting after the fact, after the markets have moved, most of the time. Or you may be watching price charts that update after the price of any asset has moved. So we have to remember that is what a price chart is literally showing you. Then this results in you constantly reacting to everything instead of actually predicting. Okay? So in this video, I'm going to show you how the macro markets AI portfolio builder, okay, which I'm going to show you right now, solves this problem in minutes, because it allows you to track and read the macro regimes and the economic data that predicts where the global markets are going with an 85% certainty, going back since 1948. And it does this in minutes. So the app tells you the exact macroeconomic environment you're currently investing into. So right now, as we speak, we're in a normal expansionary phase of economic growth. Okay. And once you understand what regime we're currently in, this automatically means that the macro app will align a portfolio to help you construct your investments for the current environment across stocks, bonds, commodities, crypto, and more. So you stop guessing, okay? And you start investing with certainty that your portfolio is built for the world as the data actually describes it, not after the fact. Now, before I show you this revolutionary app, I want to name something that most people won't really say out loud. The reason you ask yourself the question, is now the right time to invest? And that question becomes so paralyzing is because the absence of a framework, a macro regime framework, means that whenever you're checking the news, or the news is already reporting what's already happened, or maybe an analyst is giving you their expectations, okay, or maybe you look at the charts, okay, which are backwards looking, and it's not going to tell you anything about the future. None of it gives you a clear read on where the economies of the major countries are going. And without that knowledge of where the economy is heading, you cannot confidently know whether now is the right time to be investing, because the markets are not random. They move in response to economic expectations. So when the economy is expected to grow, earnings are expected to grow. Okay? And this is where the macro app actually starts to educate you and show you the best sectors, where they perform the best when we're in, for an example, an economic growth environment. And it will start to educate you. It's all to do with revenues. It's all to do with earnings. All right. And once you understand, for an example, that it's the stock markets are moving in response to economic growth, as I said, with earnings rising, then stock prices will follow. And if you get a period where, for an example, the economy is going to slow, let's say we're moving into a recessionary regime, well, then the app's going to educate you, for an example, in the best places that have historically performed well in that environment, but also where you're likely to see sectors and assets really underperform. So for an example, higher multiple growth stocks are long duration equity, falling growth expectations, crash valuations hard. Okay. So in the opposite situation, if we're going into a recession, then you're going to start to learn the earnings decline and the earnings going down in expectations, then this is why the stock markets fall when we move into a recession, okay, from the economy. The signal is always in the macro data. Before the markets move, they're watching the macro data that tracks the expectations of economic growth. Not the news headlines, not the price charts that you may be looking at, the macro data. And the investors who constantly stay ahead of the markets and they predict where the markets are going, they're not the ones reading the news headlines after the fact. They're the ones reacting to the data that drives those specific headlines months before the market has actually caught on to the fact of where the expectations of the markets are moving. That's the edge in investing that you need to have. And that's exactly what the Macro Portfolio app was built to give you in minutes. Now, over the years, I've personally educated thousands of investors inside my private investment communities. And I spent thousands of hours studying the macroeconomic cycles and the framework that professional investors use to read the current macro environment before they deploy a single dollar of capital into the markets. And one thing I've learned with absolute certainty is this: that investors that consistently build wealth across full market cycles, they are always reading the macro regimes that predict where the markets are going with an 85% certainty every single month, with the same rules, the same discipline, the same framework that is inside this macro app. So let me show you exactly how this works. So here's exactly what I'm going to be covering. Firstly, we're going to be learning why the markets follow the economic cycle, and why understanding what stage of the economic cycle we're currently in is the foundational question every investor needs to answer before they commit any money to the financial markets. Secondly, I'll be educating you on the macro regime scoring system inside the app and how this platform reads the live macro data every single day, how it scores the data that tells you the 6 macro regimes, and how this then feeds, thirdly, into the AI portfolio builder. Okay, so a portfolio will be constructed for you for illustrative purposes, and this portfolio you can backtest in real time, and you can test the performance of the illustrative portfolios so you can understand that AI is giving you high quality education and illustrative portfolios that will massively outperform historically the major benchmarks, for an example. So the S&P over this 10-year period was up 300%, but the illustrative portfolios that you'll be presented with are 500%. All right. And this really does help you not only learn about the macro regimes, but also understand the asset classes that perform best in the specific environment that the macro data scorecards are telling you we are currently in. Okay. And fourth, once you have built your illustrative portfolios, for an example, you can then in real time be able to have AI continuously monitor the data in the background and give you early warning signals telling you when the macro regimes are about to shift. So you know before the markets catch on to what's actually going on in the background. So let's start from the beginning. Okay, so now let's look at the framework, okay, and why the economic cycle is everything to an investor. So I need to show you the principle that this whole macro regime is built on. Because once you understand this, every investment decision you've ever second guessed will make complete sense moving forward. All you need to understand is the markets are forwards looking. They don't price in what's happening today. They price in what investors collectively expect for the economies to do over the next 6 to 12 months, which means the stock market is not a reflection of current economic conditions. So please remember this. It's a reflection of economic expectations moving forward. All right. And those expectations are driven by the real, measurable, publicly available macro data released on a predictable schedule every single month. So you're going to start to learn, for an example, the major business surveys that get released every single month, and it tells you whether companies are expecting their earnings to expand or contract. And you'll start to learn why the S&P 500, for an example, which is a reflection of the economy, literally goes up and down alongside these very important business surveys. Okay. You'll then start to learn consumer surveys that tell you whether companies are expected to have their earnings rise or fall, because that is being driven by consumer spending. All right. So the confidence of consumers is critical. And there are certain levels of GDP growth which are predicted with certain levels of consumer confidence. All right. And then you'll start to learn how to track inflation data that tells you where the prices of interest rates are going. And interest rates are everything to the market. So you can see into the future as to where interest rates are going for the major economies. Okay. And this is very important because once you understand where interest rates are going, you'll start to have a clear read on the bond market. And the signals that that tells you is one of the most informed investment pieces of information that everybody is watching, because the yield curve has predicted every single US recession in the last 50 years, every single time. Okay. So altogether, this data, it paints a picture and it tells you what the macro regime we are in for our country's economy. So here we're looking at the United States in our example. All right. And the regime will then tell you which assets historically outperform in this environment and which assets face headwinds. So this is not theory, what you'll be learning. This is like historical evidence, which is why when you come down into the sections, you start to learn about the best performing sectors during economic growth. You start to learn about how commodities like gold or government bonds can diversify your portfolio to cushion shocks when the markets may fall, for an example, if a war kicks off, and it will warn you of the assets that really do kind of underperform in this macro environment, so you don't waste your money investing in sectors that are not really going to see massive gains. Okay. So this is the operating framework that I promise you every single hedge fund, pension fund, and institutional asset manager on the planet is using. And now it's inside the macro app being updated for you every day in minutes whenever the macro data is released. Okay, so the macro portfolio app, it scores the economy over 7 macro regimes. So there are 4 primary regimes, the core economic environments that determine the fundamental direction of the markets. And then we have 3 secondary cycle signals. Now these fire alongside the primary regimes as additional risks and opportunities start to emerge. Okay, so I'll walk you through each one step by step. So firstly, the primary regime, which is happening the vast majority of the time, is economic growth, when we're seeing a regular economic expansion. So this is where the economy is growing. And this is where business surveys are strong and they're rising. Consumer confidence is healthy. For an example, corporate earnings are expected to grow. So in this environment, equity markets will perform really well. Okay, the cyclical sectors will lead. All right. Technology, for an example, will outperform. Consumer discretionary sectors historically are very healthy and perform very well. So the stocks in these sectors will likely go up aggressively. Okay. And essentially, you have other sectors as well, like the financial sector, so banks and industrials, energy sector, real estate. All of these sectors are flagged by AI as the best sectors that throughout history are going to see their earnings expand. Okay. And this is the environment where being invested fully in growth assets, we call these cyclical stocks, and these sectors have historically generated the strongest returns for investors. Then the second primary regime that we have that happens once every 5 to 7 years is a recession. Now, a recession is when the economy is contracting. And this is usually because the business surveys have broken down. Okay, they're both below the levels of 50 and they're declining, which is something you'll learn when you come into the portfolio app. Okay. Consumer confidence has fallen below specific levels. For an example, corporate earnings expectations in this environment are being revised down sharply. Okay. And investors are now rotating in this environment out of the cyclical sectors and they start to move into what's called defensive sectors. Okay. And they start to really protect their money in government treasury bonds, which is why I was explaining that these are shock absorbers to your portfolio, and even commodities as well will perform well in these environments. But this is what happens when interest rates get cut, which always happens during a recession. And essentially, in this environment, investors play a different regime. They move into defensive assets. Okay, so they go into, for an example, healthcare companies, consumer staples, utilities. They go into treasury bonds. And this is because the macro data is signaling for them to reduce the risk in the high cyclical sectors I was previously showing you when we were going through a period of economic growth. Because investors need to protect the gains that they've made in their portfolio. Okay. And what's going to happen is they're going to be positioned in the assets, okay, for an example, like defensive sectors, where their earnings are actually very resilient to economic deterioration. So this is the second most important regime. Then thirdly, we have, which doesn't happen too often, but it does happen, we have stagflation. Now, a stagflation regime is the most difficult environment. And this is what something central banks are always trying to avoid. And that essentially means you have high inflation, but also weak economic growth at exactly the same time. This is a very unique challenge in a stagflation environment for central banks, for governments. And it's very, very difficult for the conventional equities and bonds that really offset each other, because in this environment, bonds will fall and stocks will fall at exactly the same time. Okay. So what really holds up historically in this environment? Well, you'll start to learn that when stagflation occurs, commodities always outperform. Okay. Real assets like gold, energy, and the commodities I was just explaining, these assets with intrinsic value are what inflation cannot erode. So if we ever move into a stagflation environment, these are the types of asset classes that the professional markets move into aggressively to preserve their wealth. Because stocks can't save you, bonds definitely can't save you, well, specific bonds anyway, and they rotate into other asset classes. Then the fourth regime we have is a growth recovery. Now, this happens when the economy is coming out of a recession. And this is when the leading indicators, which you will be learning about, are beginning to turn and signal that economic growth is returning. So the business surveys start to stabilize. Central banks start cutting interest rates aggressively. Okay, this is the early phase of the next growth cycle. And historically, it's one of the best opportunities for investors who are positioned early, because the assets that will lead the next growth phase are still trading at recessionary valuations. So they're at really good discounts. And when the markets turn, they start to pick up and move aggressively. So this regime is a transition to economic growth from a recession. Okay. And there are certain signals that you have to understand to look out for to know if we're coming into the economic growth recovery environment. Then we have secondary signals. Now, these are always happening in the background of the major primary regimes we just covered. So we have rate hiking cycles. So this is when central banks are tightening monetary policy very aggressively. So interest rates are rising fast. And the cost of borrowing is increasing across the economy. And the signal basically for this regime fires alongside whichever other regime is primary at the time. So we could be going through economic growth period, or maybe we could be in an economic recession or slowdown period, and something may happen with the energy markets that can cause inflation to spike. Okay. So it flags sectors and assets that face specific headwinds from rising interest rates. All right. And once you understand and it identifies which asset classes historically benefit in this environment, well, then this detection engine uses real-time pricing from the market's expectations of interest rates, and it allows you to see in real time when the markets are really starting to price in higher and aggressive interest rates. And then you'll learn where are the best performing sectors that always outperform during a period of high interest rates, like the financial sector. So banks will make good money when interest rates are going up, for an example. Or again, defensive sectors will see capital rotate. Or if we're seeing interest rates go up because there's been an energy shock, the market's going to start to buy the energy sectors. So oil and gas, for an example, or specific commodities that could be causing interest rates to go up. So if you can get a read on why investors are pricing in interest rate expectations, then you're going to understand that you're going to be able to move early before the average investor who waits for the Fed to confirm that the rate hikes are coming, but by that time it's already too late. The markets have moved. So this macro app signals before the announcement by central banks, long before the announcement, that interest rate hikes are coming. And then we have the complete opposite to interest rate hikes. We have interest rate cuts. And central banks will loosen monetary policy, and this is when interest rates are falling. And this is when liquidity is being injected into the financial system. And this signals, historically, that this is a strong tailwind environment for risk assets like stocks. So whenever interest rates go down aggressively throughout history, the stock markets always perform very, very well. Okay. And if you can understand the relationship between lower interest rates and the bond markets, you can make fantastic money on investing in long-term bonds, as well as transitioning into certain specific sectors in the stock markets that always throughout history outperform whenever interest rates are going down. Okay, so that could be equities. Gold always performs well when interest rates are going down. Cryptocurrencies perform well when interest rates are going down. Okay, and other sectors. And again, this is detected from the market pricing that we saw in the macro tab regime, where it's pulling all the data in minutes from the live markets. So you see what's coming ahead of time, and you can position before the move happens, not after the move. And then we have, which doesn't happen very often, but I'm sure you guys are aware what happened in 2022. Okay, we know that Russia invaded Ukraine, and we had a sudden dramatic rise in energy prices. Oil and gas prices went through the roof. Broad commodity prices were surging. Everybody's energy bills were going crazy. And the markets took a hit because energy prices exploded overnight. Inflation accelerated at the fastest pace since the 1970s, I believe. And the central banks had to do something fast, and they raised interest rates aggressively. And the stock markets and the bond markets fell aggressively in 2022. We saw sharp declines. So if you don't understand that an energy shock may be coming, you may be holding certain assets in your portfolio that will get killed in this environment. Okay. So in this environment, investors who positioned in the energy stocks and the energy sectors that was causing the inflation and the commodities that were causing the inflation, they made a killing. And this macro AI generated app will give you the insights early. So when the energy shock signals fire, the app flags the risk in your portfolio. It gives you illustrative examples of the best performing portfolios in this environment, so you can make your own informed decision before the rest of the markets catch on to what's really happening. So here's how the app determines which regime is currently active. So every day, the macro portfolio app tracks the key macro data as it comes in and is released to the public. And this is being driven from our macro data tab. All right. So it's tracking, again, the business surveys, consumer surveys, inflation data. It's looking at interest rate expectations, the yield curve, GDP growth signals. And this is giving you the expectations of corporate earnings, how commodity prices are going to react, how the bond markets or crypto. And for each regime, okay, it's continuously running a scoring engine. So each data point that aligns with a given regime is added to its score. And each data point that contradicts to a regime reduces the score. So the result is you have at all times a live regime score for every single type of environment we could be moving into, and it's telling you where we currently are today as the data arrives. So the primary regime with the confirmed score becomes the active regime. So we can see right now we're in a period of economic growth, economic expansion, has the highest score out of all the regimes. Okay. And the secondary signals of the other regimes, they run in the background and they're firing alerts when the raw data crosses certain specific thresholds. Okay, so this allows you to read the numbers, start to predict, okay, what the data is telling you, so you can understand where we are now and what's likely to happen next. Where are we heading? Because this gives you the confidence to ask that question. Is now the right time to invest? Well, once you know the different types of regimes and the different types of portfolios, it doesn't matter where we are or where we're going. There's always a portfolio that is suitable for every type of macro regime. You just need to understand and have the education. So instead of you reading, again, like we spoke about at the beginning, instead of you reading 10 different articles and trying to understand all these different opinions, you simply, guys, come over here, open the app, see what regime is currently active, so you know exactly what that means for your portfolio. Now, this is how the whole portfolio app starts to connect. So the active macro regimes directly feed into the AI portfolio builder. So once the scoring engine has confirmed the current macro regime, the portfolio builder uses that as a starting context. And it shows you the asset classes and the sectors that historically outperform in this environment across bonds, across stocks, commodities, crypto, and other assets. Not based on some hopeless articles which you may be seeing across Bloomberg or some random opinions. This is based on what has historically happened in every previous period when the economy was in the same regime. So I'm talking about looking at decades of data. So if we're looking at an AI bubble crash, well, what happened in the last AI bubble crash with this illustrative portfolio? The markets went down 40%. This portfolio went up 12%. What happened with the last interest rate hiking cycle? Well, this portfolio is going to show you when the markets went down 18%, this portfolio went up 14%, for an example. Or what happened on the last energy shock that we had? Okay, and we'll look at multiple energy shocks. So you can really start to see in the last historical 2 episodes when energy prices went through the roof, well, what actually happened? Well, the major stock market indices went down 20%. This portfolio was up 24%. And again, for an example, in 2021 to 2022, the markets went up 4%. And then when it rotated, this went up 60%. Okay, so real data will tell you how each portfolio, which is being generated by AI, has historically performed in the past. And it gives you fantastic context. So for an example, in a recession, when the markets are down 46%, this is up 10%. When the markets are down 39%, this is up 16%. All right, so it really does help you understand that this is not just based on opinions, it's based on real-time data that you can stress test, that you can start to use to translate into a regime-specific illustrative portfolio. So your portfolio isn't built on hope. It isn't built on someone else's opinion. It's built on real historical evidence of what has worked previously in similar environments. Okay, so you can see exactly what is likely to happen if you take these illustrative portfolios and you start to do your own research, backtest these portfolios, adjust these portfolios, make it precisely to the levels that you want to target. So in terms of risk and returns, and then you have the confidence when you are ready to make your own investments because you have the education to invest your money based on what has happened in the past, not based on hopeless guessing, which is what 95% of retail investors unfortunately are doing, and they end up making terrible mistakes and losing a lot of money. Now, here's one of the major parts of this platform, which most platforms, if not any, really offer their clients. Okay, and not only does the macro portfolio app track the current macro regime in real time, but it monitors incoming data for early signals that the regime is about to shift. Because the biggest risks to any portfolio is not a market crash, it's being positioned for the wrong regime. So having, for an example, a growth portfolio when the data is clearly signaling a recession is impending, or a defensive portfolio you may be in, but now we are in an economic growth recovery and you're going to be positioned in the wrong sectors, in the wrong stocks, in the wrong assets at the wrong time, and the markets could be going completely against you. Okay, so the app will continuously track whether incoming data is strengthening or weakening the active regime score that we have. And when the data comes in that is inconsistent with the current regime, the app flags it and it identifies which direction the data is pointing, and it shows you a specific indicators to watch and what you want to potentially remove from your portfolio or watch like a hawk, okay, for an example. And then it will also help you understand which assets will perform very well in the environment which is being flagged up. So here's a beautiful example as I record this video. Here is the economic growth illustrative portfolio that would help you construct your own economic growth portfolio, because you would understand the asset classes that perform the best in this environment. However, recently, the war between the US and Iran has kicked back off. Energy prices have shot up, and this has caused semiconductors to drop by 20% and the technology sector to drop by around 15%. Okay. And if you had technology stocks or the technology ETF, which kind of owns the whole sector, and some of the best performing semiconductor ETFs, and these are the major sectors which most investors are heavily invested. If you was invested in these sectors, or AI would flag it to you immediately and tell you, hey, the semiconductors are really down nearly 20%. Technology is down around 12%. You should be very careful about your portfolio, because these are big moves that are happening right now. So it would tell you in real time what assets in your portfolio specifically could be in danger. And then it would give you some historical context of what assets perform the best in this changing environment. Now, this is so important for you as an investor to have this education, have this knowledge, and have this being flagged in real time. Because what this allows you to do is use the macro regime as evidence when changing conditions are building, and you have an early indication because you are now aware that you can review your portfolio, you can prepare, maybe you reduce certain holdings, maybe you replace certain holdings with other assets. So you are now reading the macro data before the market has priced in what's actually happening. Okay, I'm talking about the vast majority of investors. And honestly, that's the difference between being the investor who is always one step behind and being an investor who is positioned ahead of time when the regime scores flag risks and even opportunities to your portfolio. So let's bring this all together. The question was at the beginning of this video, is now the right time to invest? A very logical question that pretty much every single person I ever speak to who think about investing, that's one of their biggest worries. Well, should I really be investing now? What is likely to happen next? And I don't want to lose all my money. And if that question has no clear answer, because they're trying to answer it again with news, opinions, price charts that we looked at, none of this will give them a forward-looking economic read on what they actually need to be paying attention to. And the macro portfolio app changes that. Again, it tracks the macro data every single day. It scores, the economy across the major regimes. It tells you which regime is currently active and what that means for the asset classes for that specific regime. And when we're in other regimes, again, you would understand what asset classes are likely to perform best based on historical evidence in that specific environment. Okay. It feeds the regime into the portfolio builder as we looked at. Okay. And this allows you to go and start to construct portfolios based on historical evidence of what portfolios perform the best in these macro environments. And then again, once you're in a portfolio, you're going to get early warning signs that are flagged up when the regime is beginning to shift, when there are changes that could catch you off guard. So the result is you have clarity. You are able to invest with confidence. You have more certainty about the risks you're taking and even the expected returns that you can expect to receive in your portfolio, because everything is back tested. The macro regime framework has historically predicted the direction of the global markets, as I was saying to you, with an 85% certainty, go back to 1948. That's not guesswork, that's structure. And a structure is what gives you the confidence to invest, regardless of what the news is saying, regardless of what your friends are saying, regardless of what a random analyst on the TV or maybe you be reading in the newspaper. Their opinions become secondary. You now have the real framework that enables you to make rules-based investment decisions with confidence, clarity, so you can make fast decisions and have the confidence to know that you are making educated investments and not gambling. So everyone, now that question 1 has been answered, is now the right time to invest? The answer is always going to be the same. The regime scores we just looked at is always going to tell you. Okay, it's always going to give you the confidence to know what regime the economy is currently in. Then the next question becomes only natural. Well, where do I actually invest? Like which specific sectors, which asset classes, which specific stocks, ETFs, commodities does the current regime point towards? And how do I combine them in a portfolio that captures the opportunity that I want to capture without taking unnecessary risk? And that's what video 2, the following video to this, is going to cover. So really watch out for that next, okay? And if you want to go through this portfolio app in more detail, okay, there's a link in the description that takes you to another training session on the app, free training, and enables you to book in a live strategy session with me. And we'll look at your specific situation, where you are right now, what kind of capital you have to deploy, what your goals are, and I'll show you how you can use this AI generated portfolio builder, okay, to really construct something which is really personal to your desired goals. All right, this is not a sales call, this is a strategy session. And I'll walk you through it and it'll give you a lot of clarity and confidence. And if I could offer you a helping hand and achieve your goals, I would love to be of service to you. Okay, guys, so thank you for watching. Appreciate your time, and I'll see you in video 2.